Welcome to this explainer. Today, we're pulling back the curtain on something absolutely fascinating. We are going to uncover the hidden institutional footprints that actually move the financial markets. We're talking about how the real smart money operates, focusing heavily on supply and demand zones, and how they intimately overlap with institutional order blocks. So let's just dive right in. So, why do most retail traders consistently lose? It's a painful reality, right? But the brutal truth is that retail traders often fail because they unknowingly act as liquidity for the market's biggest players. You see, price isn't moved by you or me. It's moved by large institutions placing orders massive enough to completely clear out the available supply or demand at a given level. To really wrap our heads around this, let's look at where this concept took off. Sam Seiden, a former execution clerk right on the trading floor of the Chicago Mercantile Exchange, had direct access to the live flow of buy and sell orders from major institutions. He noticed a massive behavioral gap between professional institutional traders and novice retail participants. He realized that if you just know what you're looking for, simple price action on your charts reveals exactly where these massive players are operating. Here is our roadmap for today. We'll cover the smart money advantage, supply and demand zones, spotting institutional footprints, the order block connection, and finally, validating and trading those zones. Let's get to it. Starting off with Section 1, the smart money advantage. There is this darkly ironic dynamic in the markets. You know how it goes. Novice traders routinely buy immediately after an extended rally, driving their capital straight into a wall of institutional sell orders, effectively trapping themselves. Professional traders? They simply sit on the opposing side, absorbing all this retail liquidity to build massive, favorable positions before driving the price the exact opposite way. Moving on to Section 2, supply and demand zones. Okay, so what exactly is a supply zone? Think of it as a specific price area where aggressive institutional selling completely overwhelms the buyers. It drives the price sharply lower. And because these massive institutions literally cannot fill their entire positions at a single price without causing major slippage, they leave unfilled sell orders behind. This zone represents the absolute origin of a powerful downward move. On the flip side, we have demand zones. This is a price area where aggressive institutional buying absorbs all available supply. Once that last seller is gone, and you still have thousands of buyers left at that price level, the price must rise. This creates a launch pad, leaving unfilled buy orders resting right at its origin. This really illustrates the math behind the madness. Imagine 3,000 buyers competing against just 200 sellers. That brief sideways price action right before the jump gives the illusion of balance, but under the surface, it's completely out of whack. Once those 200 sellers are absorbed, the remaining 2,800 buy orders literally force the price to skyrocket. So ask yourself, whose demand is this? It's sure not retail. Retail traders simply don't have the buying power to cause a rally like that. This is a pure, unadulterated institutional footprint. Now, here is a real game changer. You've probably been taught traditional support and resistance, where the more a level is tested, the stronger retail traders think it is. But supply and demand zones are the exact opposite. They are drawn at the origin of a strong move. Every single time price revisits a zone, it consumes those resting institutional orders. Therefore, a virgin, totally untested zone carries the absolute highest probability of a reaction. Repeated testing actually erodes their power. Which brings us to Section 3. Spotting institutional footprints on the chart. When we look at the price action here, check out the drop base rally at the bottom, creating our demand zone, and the rally base drop up top, forming our supply zone. That base is just a brief consolidation period, usually about 2 to 5 candles, right before the explosive directional move. That explosive departure? That's your institutional footprint. The space right in between these two zones is what we call the profit margin. To make sure we aren't just getting faked out by random market noise, you really need to know the hallmarks of a valid zone. You're looking for a tight consolidation base, followed by a sharp, aggressive departure leg. This is the signal that massive, unfilled institutional orders remain. What you absolutely want to avoid are wide, messy, overlapping candles in the base. A tight base means decisive accumulation, while messy candles just scream indecision, not the clear intent of smart money. All right, Section 4, the order block connection. Now, you might be wondering how this relates to order blocks. While both concepts are hunting for institutional order flow, there is a geometric divergence between them. Supply and demand zones generally map out a broader multi-candle base. order blocks, which are super popular with smart money concept traders, zoom in on the specific, single opposing candle right before the impulsive move. Think of an order block as a hyper-precise, narrower version of the exact same underlying idea. The anatomy of a valid order block comes with some pretty strict rules. It's the final bearish candle right before a strong bullish push, or the final bullish candle before a drop. It represents the exact moment of institutional absorption. Crucially, a valid order block must cause a break of structure, meaning it actually breaks a previous swing high or low. And often it leaves behind a fair value gap, which confirms the move was genuinely institutional and not just a random retail spike. Because it focuses on a single candle, it allows you to operate with much tighter stop losses.
Finally, Section 5, validating and trading these zones.
Take a look at how this plays out. See how the initial massive demand exceeded supply, launching the price upward? Well, the magic happens when the price eventually revisits this virgin area of imbalance for the very first time. Because we objectively know there are massive, unfilled buy orders resting there, this pullback offers an incredibly low-risk, high-reward, and high-probability buying opportunity. Patience is absolutely vital here.
So let's put it all together into an execution playbook. Step 1, find that strong impulsive move on your chart. Step 2, locate the order block or the consolidation zone right at its exact origin. Step 3, and this is the hardest part for most people, sit on your hands and wait for price to retest that virgin zone. And step 4, confirm your entry. You can do this by looking for a rejection candle, checking footprint charts for volume absorption, or just waiting for a lower time frame shift in structure. Once you really grasp supply and demand zones and order blocks, it completely changes how you view a price chart. You stop staring at arbitrary historical lines, and you start seeing the active mechanical intent of the market's biggest players. So I'll leave you with this provocative thought. In your next trade, are you going to patiently wait and follow the smart money, or are you going to jump in early and act as their liquidity? The choice and the edge is entirely up to you. Thanks for joining me on this explainer.